as investment advice or a recommendation to buy shares in the company featured. Welcome to this Stockbox interview. Joining me on Stockbox today is Adam Davidson, the CEO of Trident Royalties. Now, Trident Royalties is a company operating in the royalty model, which is very common in North America, but a bit of a unique proposition over here in London, where the shares are traded on the AIM market. So, hello, Adam, how are you?
I'm very good, Mark.
Good. Well, thank you for joining us. It's interesting to have a royalty company. So I think maybe we can start with it being the first time we're talking. Maybe just give us an overview in a few words. What is the royalty model? How does it work?
Yeah, sure. I think most people are probably pretty familiar with it from, movies and music. That's where you most often hear about royalties. And in the mining space, it's not hugely dissimilar, to be honest. Effectively, a royalty entitles the royalty holder to a percentage of the revenue from the underlying operation. So with that conveys a few key benefits. In particular, by getting just a percentage of revenue, you're not directly exposed to operating costs and capital costs. So I think we've all been in this position where you invest in a company, and you may even get sort of the broader thematic, right? Metals, in this case, metals and mining start performing well. You got all that right, but what you find is that the operator has cost blowouts, or they're out there doing sort of ill-advised M&A. And effectively, they're using equities money to do those initiatives. Now, as a royalty holder, you're not exposed to that, at least not directly, because you're just getting your percentage of revenue. So whatever happens at the bottom line of the profit and loss statement, that's effectively equities exposure, and we're exposed to the top line, so we just get exposure to the revenue. So if the underlying metal performs well, then we see our revenues increase. And I guess the balance that royalties then strike, though, is you still get some of that. You still get really the bulk of that equity style uplift exposure, in the sense that if they turn around and reinvest in the asset, or they drill it out more and expand the life of the mine, or they expand the plant to increase throughput, all that benefit, that increases their revenue, so it benefits the royalty. And that's effectively using equities money, though. It's using money off that would otherwise be profit, and reinvesting it in the asset. Whereas the royalty, once it's put in place, you don't put in a dollar more, you're not diluted. It just sits there and it collects its portion of revenue. Typically sits senior in the security waterfall, certainly gets paid before even senior debt gets paid. So it's just a financial instrument, really, that gives you that exposure, but from a much more risk mitigated type of perspective, but still preserves that equity style upside, which is why the model's really taken off in North America.
Yeah, I know it's very popular in North America, but as I say, it's fairly unheard of here. In terms of if shareholders want to know how they get a return, I mean, presumably there is the capital gain in terms of Trident Royalty share price going up, but do you also then look to distribute capital at some point as well through dividends?
Yeah, we're a new company, so we don't have a dividend right now, but that is very, very much the intent. As you can imagine, when we launched in June last year and listed on the AIM, we had just one single paying royalty, and now we have two royalties, a third that's in construction, a fourth that's really moving in the right direction, and we have a total of 11 royalties in sort of 8 months since listing. And so as you can continue to build out the portfolio, you start getting this diversified source of revenue from various commodities, in our case, and various jurisdictions. And that lends itself to a very stable dividend policy. So that is the ultimate objective. Is we're a growth company, so we're building pretty aggressively at the moment. But in the near term, you can start to let some of that flow through directly to shareholders via dividends. That's very much the intent. Okay. So what royalties do you have then? You mentioned 2 in production there. Do you actually have an income stream now then? Yeah, we do. Yeah, we've got 2 in production, and I think the type of commodities I think that people could want to have exposure to, particularly given where we're at today. And in fact, I was reading that a report that said central banks have injected $6.6 trillion in liquidity in financial markets just since March, and have another $5.8 trillion that they've committed to that hasn't yet flowed in. So So you've got all this sort of an inflationary pressure, and you see that. I mean, commodities are a direct hedge against inflation. That's where they're most often utilized by generalist type investors, and that's no more evident than the two paying royalties that we have. One's over a copper asset, which is ramping up production,
Mm-hmm.
and the other one's over an iron ore asset. Copper's now sort of exceeded its 10-year highs, and iron ore is sort of knocking on the door and just about there. Yeah, actually puts it in perspective. When we bought the iron ore royalty, iron ore was at $85 a ton. Just recently hovered up near 175.
Okay.
And copper, when we did that deal, it was around $5,800 a ton, and has crossed 9,000.
Mm.
But yeah, so we get revenue from those two assets. For example, the iron ore royalty, we acquired it for 6.65 million Aussie last year. And over the course of last year, it's paid us back just over 2.4 million in that year. So a very healthy return, given it's only been in our hands for a year. And the copper project's ramping up. In addition, on that one, we've got a minimum payment schedule. So as we wrote that royalty, we could sort of put in some mechanics that we like to see, and given it that they are in ramp up, it pays us a minimum of 1.5 million US this year, and then if they hit their sort of production targets, you'd see them exceed that.
Mm-hmm.
And then obviously you get the direct benefit from when the commodity prices are performing well.
Mm-hmm.
And then as mentioned, we've got a third royalty. It's not over the entirety of the project; it's over a portion of it, but that project's now been fully funded for construction, and commenced construction, in fact, about 4 or 5 months ago. So we'll be coming online this year.
Okay. So what about when you go about finding compelling mining projects to take a royalty in? How does it work? How do you conduct the research? How does the procurement process work? How do you decide to go for something that is either revenue generating now, or is it at an advanced stage, or an exploration stage? What's the kind of thought process and strategy that's behind it all?
Yeah, I mean, and this is really no different from our experience. So the management team, by and large, we all come from private equity backgrounds, specific to the mining sector. So we've been doing this for some time. And the diligence process is really no different in that sense. And that is, as you know, we do sort of prioritize, or certain commodities or production stage, whether it's early stage exploration or very close to production. Different segments sort of pique our interest most. It's fair to say that we're targeting near production or production assets. We wouldn't turn away an attractive exploration asset, but it becomes a little bit lower priority. But once you've identified a good opportunity, from there, it's really just running it through the standard process of doing initially an in-house review, and then
Mm-hmm.
and then as the transaction picks up steam and you're advancing things on the commercial negotiation front, you're sort of also tapping into technical experts and legal and tax and everything else to ensure that you're properly diligencing the asset, and that the return profile you're modeling is in fact how you expect the asset to play out. So in that regard, it's kind of what we're used to and what we've been doing for some time.
Okay.
And really, the question when we IPO'd was are there enough opportunities out there in the space for you? Most of our peers are precious metals focused, so a lot of investors quite understandably asked, is there the same opportunity in the in the more diversified? Because to be clear, we focus the entire mining sector. In fact, we're looking to build a portfolio that's almost index fund like with regards to exposure to all the mining commodities. So we want to get as close as possible to replicating the global mining exposure. So that means about 1/3 precious metals, 1/3 base metals, which are copper and nickel and zinc, and then 1/3 bulk commodities and battery minerals, the likes of iron ore and lithium and cobalt. We want to be able to provide investors, if you can sort of explain the theory behind royalties and why they're a good way to get your exposure. And you just look at the North American precious focused guys, sort of, I think, upwards to 70 billion in market cap. So clearly that story resonates with investors. They get why it's a good way to get your exposure to the sector. But the offering that's lacking in the space, and at the moment, is an offering that through a single share gives you full diversified exposure to the entire breadth of the mining sector. And that's what we're looking to build. And off to a good start. We've got gold exposure, we've got iron ore, and we've got copper, and definitely not sitting on our hands. So intend to be adding to that in the near term.
Well, that brings me on to my next question. What is the roadmap then going forward?
Yeah, I mean, for us, it's probably twofold. You want to, so one element that is a key consideration in the royalty sector in particular And because of the benefits that royalties have over mining equities, they tend to trade at a premium to mining equities, but you don't get that premium unless you have a full diversified portfolio that's generating cash flow. So if a junior royalty company is trading at 1 times net asset value today, as you grow and grow, the very, very big boys occasionally trade upwards to 3 times net asset value. So with each deal that you do, not only is that single deal accretive, you should be making a return and adding value per share with each deal. But then as you grow in the portfolio, your entire portfolio re-rates on how it's valued. So you get this sort of coupling effect. And it's pretty powerful with regards to returns. So our focus is very much to build out the portfolio, add more diversification by acquiring more royalties, generating more revenue. At the moment we've got revenue coming from copper and iron ore, and good line of sight of where the revenue will come from precious metals. But we want to continue to expand the breadth of that. So that's very much the focus, as we are a growth oriented company.
Okay. And why did you decide to go for the London market then? Was it just an opportunity you saw there because there's so little royalty companies listed in London?
Yeah, it was a couple factors, and that's one of them. And we did, to be fair, get quite a few questions at the time of why London. I think one thing is clearly it's one of the biggest capital markets in the world, and if this model resonates in Toronto, no reason why it can't in London. And I think the other consideration is although mining may not feature in many people's minds, it is quite a focal point of the mining sector. A lot of African projects, the companies are domiciled in the UK, and so between myself and North America, my colleagues in the UK, and then my other colleague in Perth, Australia, we've got pretty good global coverage. I think with regards to would we get traction in the UK, that answer is starting to it's starting to be answered for itself. Initially it was a bit of an open-ended question when we initially listed, but what we've seen is as we announce deals, we see response from the market through the end of December when we did our analysis. On an annualized basis, we turned over 54% of the register, so people can get in and out of the stock as they need to. When we announce deals, we categorically we've seen a pop in share price off the back of each announcement. So we're sort of seeing the traction that we need to see. And then more broadly, I think you'd sort of step back and say London began, 2020 with one mining-focused royalty company. When we came along, it was the second, and one of the very biggest companies, Wheaton, which is primarily listed on the TSX. They did a dual listing in London. They clearly saw an opportunity there, and they're tens of billions market cap company. And then the Ghanaian government's in the process of publicly listing their government gold royalties, and obviously had the pick of where they wanted to do that, and have selected London, and that's sort of rumbling forward for listing this year. So nobody's quite doing exactly what we're doing, but I think you can say 2020 started with one mining royalty company, and I think we'll in 2021 with London having at least 4. And as we're getting more of a track record on our front, I think we're pretty comfortable with the decision we made there.
Okay. And just a final thought from you, Adam, just on the mining and exploration sector. Where do you feel it's heading? Do you feel we're on the cusp of a big bull run in the sector, as I'm sort of seeing a lot of headlines going around at the moment?
Yeah, it's funny that you mentioned that. We're increasingly seeing those headlines, and it's probably not a surprise. I mean, there's this broader macroeconomic backdrop of COVID-19 and lockdowns and economic recessions and trade wars and everything else, and inflation is starting to now appear as one of those key concerns, and it's sort of started as a trickle and starting to pick up pace. And you see that the IMF, I think, doubled their advanced economies inflation forecast for this year. The University of Michigan inflation survey, which is pretty widely referenced, the most recent sort of pointed to 3.3% inflation over the next 12 months. U.S. bond yields touched their lowest earlier this month, lowest ever, and have now turned and are moving hard in the other direction. So it's all sort of driven by the fact that money's pouring into the sector. The printing presses are on at central banks, and now when you see the likes of J.P. Morgan and Goldman Sachs and other TD Securities, they're all sort of going out there starting to flag you should get some inflation protection, and commodities are the best way to do that. So once you see sort of the broader sectors start to make that kind of pivot, it then flows through. So we feel like perhaps a bit unintentionally, but we probably got our timing right in that regard. That mining does seem to be, it's been unloved for probably the last kind of 10 years. And that sort of, you get this compounding effect because then there's underinvestment in the sector. And then when it does turn, everybody's scrambling to catch up. And so the demand outstrips supply, and all the fundamentals take some time. You can't turn a mine on overnight. There's a long process from discovery to construction and production. That's why you have cycles in the commodity sector. Is demand can turn on a dime, but supply doesn't follow that quickly. Throw in some pretty heavy inflationary pressure, and I think we're on the cusp of. I'll put it this way: I'm very pleased to be in the position that Trident's in at the moment, because we've built out a good portfolio. We're continuing to do so, and we're gonna be exposed to this sort of broader thematic going forward.
Okay. Well, Adam Davidson, the CEO of Trident Royalties, thank you very much for your time.
Yeah, thanks, Mark.
Thank you for listening to this Stockbox interview. For more information, interviews and videos, visit our website at stockboxmedia.com or give us a follow on Twitter by searching @StockboxMedia.